I next wanted to just mention some of the future tax battles. Guys, we got the debt ceiling limitation issue that's coming up in just a matter of days that we need to deal with. The fiscal cliff was just delayed for 2 months. We've effectively had no spending cuts whatsoever. They have discussed certain spending programs that are going down or tax cut savings, but these were just stimulus programs that were one-time spots that are going away, but they're not any spending cuts of the existing programs otherwise. And one of the big problems that I saw with the way this played down is I thought we had a really good chance for significant income tax reform, and now there's basically very little talk about that. And so I think the prospects for that are dwindling, even though they're needed more than ever. So when I look what we happen is I'm very, very thankful for the current administration giving me unbelievable job security. There is not a tax accountant in the United States that's any good that will not be extremely busy for the foreseeable future. My number one business problem is trying to find and hire additional tax professionals. They're not available. They're not available in staff level, they're not available at senior level, they're not available at manager level, they're not available at partner level. And particularly, right now, there's about 8 job openings for an international tax expert for every available candidate. Okay? That's sort of unfortunate when we have super high unemployment and super high underemployment, but fundamentally it's deeper than that. It's sad that the demand for international tax experts are because U.S. taxpayers are going to move out of the United States. And they are going to move significant number of operations over the next several years unless we do have corporate tax reform. So what I'd like to do is talk real briefly about some tax planning opportunities. And this is probably the saddest part that I have. Since 2001, 2002, 2003, when we've effectively shut down non-economic transaction tax shelters, me as a tax advisor have almost advised on how to structure things for taxes after there's a business transaction in the works. So we start with a business economic viable project, and then we structure it in the most tax advantage ways we can. Okay? And the Supreme Court judge's learned hand says that's what a patriotic American should do. Okay? What I'm of the opinion, what we've effectively done with these increased rates and regime of surtaxes on top of surtaxes is we're shifting the debates. And we're starting is, I have to do something with taxes. What should I do? Now, I'm a pretty good tax guy. I'm not necessarily a very good business guy. When business guys are coming to me to ask for what type of transactions they do, we are not maximizing our economic resources and capital. You know, we're sacrificing and taking non-optimum economic decisions and letting tax decisions override them. I think that's totally inappropriate. So what are we doing on some of these? Well, one of the things we're doing, and we'll do it extremely more aggressively if they do lower the corporate tax rate from 35% to 24 or 25 or 28%, is you're going to see a mass conversion of LLCs and S corporations converting to be taxed as C corporations. I think that's an efficient capital model. I think it will lead to less revenue and less economic activity. Right now, there's about 33.6 million business returns filed of some type, whether it's sole proprietors, partnerships, LLCs, or C corporations. All but about 3 million of those are pass-through entities. The vast majority of them are sole proprietorships, but LLCs represent over 1 million. S corps are about 4.7 million, I believe. It was filed in 2011, and partnerships are several million returns. We will probably see a lot of those converted, even though by putting them in C corps will require them to be in a double tax regime of maybe 25% now, and another 20% on the 75% of earnings that would be taxed out, which would be another 15% rate, ends up being taxed at a 35% rate, versus if we leave them in LLCs, they may be taxed at this 44% rate or higher. Again, I think it's a misnomer for us to think that that makes good tax policy. That's the direction we're headed. And to me, it's very, very, very frustrating. The second thing you're going to see is something that we've seen in the 60s, 70s, and 80s, and particularly the 80s. But we've also seen it significantly last year and other years. You're going to see significant number of tax transactions that the mass plan of that tax transaction is to minimize ordinary income and create capital gains. Real estate's a great way to do that. Private equity transactions are a great way to do that. If you think about the basics of a private equity transaction, is you have a company that's flowing income. If the owner of that flow of income keeps that flow of income himself, he has ordinary rates on it. Okay? However, if he packages that future stream of income and sells it to a private equity firm today on a discounted basis, okay, he realizes a capital gain. The private equity firm gets a step up in basis, which then can be amortized to offset that future flow of income. And so we've effectively taken a substantial amount of that, other than the return, the profit to the private equity firm. We have effectively converted this to capital gain. You're going to see a lot more transactions like that. You're probably going to see significant more transactions where even if they don't sell the upside to the private equity firm, they will sell strips of preferred equity and other equity type instruments in order to create capital gains. Again, we're going to employ a lot of attorneys and a lot of accountants to do tax transactions that have no economic impact at all. And worst case is distracting good businessmen from doing economic activity to huddle in and plan for taxes rather than doing additional deals. The final piece, and this is my saddest piece, I talked about significantly now how our existing international businesses who are making significant amount of monies overseas, all of our growth markets are in Asia and other parts of the world. That's where they're making their money. And because of our current tax regime of having the highest corporate tax rate in the world, and the belief that the United States government can tax income earned in another country just because it's invested in the United States later, we have literally trillions of dollars parked overseas that cannot invest in the United States. The other half of this coin is we have an unbelievable number of very profitable taxpayers. Ones that have significant income being earned already overseas, even though all their business activities are in the U.S., and other ones who have no international revenue that are actively planning to move people from the United States to other sources. So One of my current clients now is a client of mine that makes about $30 million of revenue. 15 million of it comes from overseas, predominantly in Asia, with a little bit of it in Europe. He currently, as a business strategy and as a competitive advancement, has 100% U.S. sales force. He has 100% U.S. Customer service and support and call centers. And he has 100% of his software development in the United States. He believes that having all those three teams together, interactive and working together, creates a significant better business solution and a competitive advantage for him than maybe saving some costs by outsourcing it. However, he's just now factoring on the fact that 100% of his income is being taxed at a 35% rate in 2012 and will be taxed at a 44% rate in 2013. His competitors, who are U.S. corporations, who have made the decision to move their sales force, to move their customer service and support operations, and their development activities outside the United States to any other country in the world, it doesn't have to be the particular country, are paying effective tax rates of 15%. So whether he thinks he has a better business solution and will make more money than that, the drastically higher tax cost to him is on tilt that equation where we are going to hire half his sales force and base them internationally. We are going to move 100% of his customer service overseas, and we're not move all of his future development, with the exception of his director of development, to India. He estimates that net of some savings on the cost of it, it will cost him about $1 million more. We think that it will save him about $1.4 million of taxes per year. I don't understand the policy. I don't understand what we want to do. But these are competitive businesses. Obama's solution, instead of fixing the reason why we're not competitive, wants to penalize the U.S. company more. Okay? We have to compete against worldwide things. We're not competitive with them anymore. So what will happen is he will lose his international business if we don't allow him to reduce his tax rate by moving overseas, or try to penalize him for doing that. Those are significant planning opportunities. All three that I've just mentioned. Partners in our firm are dealing with clients on all of these every day. None of them make good policy sense, and it's very unfortunate, and we need to try to do something. I want to mention briefly corporate tax reform. This is something where Democrats and Republicans are in relatively similar positions. Both parties are proposing cuts in the corporate tax rate from currently at 35% or 34% down to 24, 25, or 28%. This is something that is desperately needed to make us competitive in the world. We have the highest corporate tax rate in the world now. We don't necessarily have the highest tax regime in the world, but we have the highest corporate tax rates. And again, people make business decisions off of corporate tax rates. I do not like our system, which is a double tax system. We tax all income at a corporate level, then we distribute that income and we tax it again, even though there's been no income earned. We're double taxing it. We're one of only a handful of countries that does that. Most countries offer a full subsidy to the extent it's been previously taxed income, you distribute it, it's not taxed in the hands of it. And dividends in Australia, for instance, are only taxed to the extent there's a distribution of previously untaxed income. I would prefer that we had a more reasonable rate and had an equalization between income earned inside a corporation versus income earned outside the corporation. I don't think one difference, I don't see any policy reason why income owned by a corporation should be taxed at a lower rate than income earned by an individual, or vice versa. I also don't see any reason why corporate income taxes should be double taxed. And what we've effectively done here, by drastically increasing individual rates and having a lower corporate tax rate, is we're pushing people into corporations. At the same time, we're giving any disincentive to distribute income from corporations by double taxing it. I think this is a huge policy mistake in the United States. Again, we're one of the few countries in the world that do this, and I do not understand it. Some people believe that the federal government intentionally wants to put more business enterprises in C-Corp forms of businesses because they're easier to control. There's not a political power against it. 73% of the American people do not believe corporations are owned by individuals. They think they're owned by some foreign alien body that it's okay to tax them. They don't realize it's owned by individuals, and it's owned by your retirement accounts, your pension accounts, and profit sharing accounts. The second provision that has not had formal proposals, but it's had a lot of discussions, is a tax holiday for repatriation of foreign earnings earned by U.S. corporations. Right now, just in the top 190 corporations in the United States, there's $1.8 trillion of cash that's overseas that's been taxed appropriately and fully in the country that it was earned. And we think that just because the shareholder is a U.S. taxpayer, just bringing it back over, we should be able to tax it again. However, we have no right or legal capability to tax it until they bring it over. So what do?
Leave it
They
there.
leave it over. So I actually had one of my taxpayers, a large international corporation that has earned a significant amount of their earnings overseas. And this is the exact fact pattern. They're looking to build a significant new plant. They would like to build it in the United States. The manufacturing process is complicated. The difference between labor costs has come closer. They would like to keep their handles on it. The problem is that if it would cost them $100 million to build that plant in the United States, and it would cost them $119 million or less in any other country in the world, it is cheaper for them to build it in any other country in the world, because they would have to pay roughly a $20 million tax to bring that $100 million back to the United States. In addition, if they didn't even bring the cash back, but they decided to build the plant in the United States and they had to borrow the money to do it, and they had to give a guarantee, a corporate guarantee, that's deemed to be an effective repatriation of that money and creates a current tax just by incurring debt in the United States. A tax holiday, in my opinion, makes sense for the current cash that's available there. If we want stimulus to do it, I'd much rather have our U.S. corporations bring money back that's parked overseas that I think is in excess of almost $5 trillion than for our federal government to continue to print money. I think it's idiotic. I do not understand it. to me, it's just fundamentally crazy. Would all the money come back? No. The reason, predominantly reason, by the way, this is just cash. There's not other investments. It wouldn't come back because we don't trust the United States to have lower rates going forward. So even though we can get it back here, the income from it would then be taxed at higher rates. But if we could have a combination of a lower corporate rate and a tax holiday, and then a refinement of future foreign earnings, I think that would be an excellent policy decision, and it would bring unbelievable stimulus to our economy to do it. And it's just shocking to me that's not being discussed in more detail. What I'd like to do is very briefly go through the major provisions of the American Taxpayer Relief Act of 2012 that was passed on January 2nd, as well as to remind us of the Obamacare taxes that became effective January 1st of 2013, which, in my opinion, were just ignored in the debate. There was a lot of conversations about we're just restoring rates back to where they were pre the Bush era tax cuts. That's not true, because over and above that, we had 5 major taxes through Obamacare that are being implemented at this point in time. The third thing I'm going to mention briefly, corporate tax reform, and in particular, I'll probably concentrate a little bit on some of the international issues that we're facing, because it is a huge part of future tax planning. I will then go through some brief tax planning opportunities that are available and that a lot of our clients and other clients are considering to implement. And then finally, I'll talk a little bit about the future tax battles that we have coming. Realistically, we just delayed the fiscal cliff by 2 months, as well as we didn't address the debt ceiling. And then obviously we basically have not implemented any additional spending cuts at this point in time. So I'll go in quickly, and what I want to do is work through the Taxpayer Relief Act of 2012 major provisions. There's literally hundreds of provisions again. It's passed so late that forms are not even available to file returns. The IRS won't even accept a return now until January 30th. Which is 15 to 18 days later than a normal year, which will delay refunds getting in people's hands and otherwise. But there were significant changes. The most overriding one is the increase of the top marginal rate to 39.6% from 35%. That comes into play for taxpayers with over $400,000 of adjusted gross income or $450,000 if you're married. Capital gain rate, and by the way, that's the full restoration of the pre-Bush era marginal tax rate. Capital gains and dividends were increased from 15% to 20%. This was a compromise provision. If we had not done anything, those rates would have gone back up to the full 39.6% rates for both of them, for dividends, and it wasn't a compromise for capital gains. But I think it's very, very, very important for us that we do have the same rate on capital gains versus dividends, because I do think it's important and make the capital markets more efficient to not punish people to pay dividends to their shareholders. I think there's sufficiency that if we can get dividends rates increase and force companies to go out and prove to the marketplace that they deserve capital being put back in them, rather than just capturing capital that they already have, will be efficient for us. A huge relief for me was the estate tax changes. For a short period of time, we had a unified estate and gift tax credit. It was going to go away. That was put in place, or stayed in place, and it's permanently in place now, that there's no difference between the credit you get when you die versus if you give it away before you die. Again, I think that makes a lot of sense. I'm happy that they left the exemption amount at $5 million. I would have been comfortable with them lowering it a little bit. I would have been a lot more comfortable increasing it, but $5 million is to me a reasonable level. But more importantly, I was extremely pleased that, again, they unified the gift versus estate tax. And what that did is it makes the capital markets a little bit more efficient. If it makes sense to go ahead and gift that to another generation and let them start redeploying that capital into the economy, they can do it. But prior to the unification of the two, your only option to defer paying a substantial tax was to wait to transfer those assets until you died. And it was very inefficient. The maximum rate did go up from 35% to 40%. Obviously, it's a lot better than the 55% rate that it has been previously. And I think that was a reasonable compromise overall. We did permanently fix the AMT issue. And one of the things I'm real happy with, a lot of these provisions were permanent rather than 1 or 2 year extensions. Historically, almost all tax bills are built on 1, 2, or 3 year bases because the budget office plans on 5 and 10 years. Almost everything's now planned on 10 years. And what they do is they have R&D credit expiring in 2 years or 3 years. And then they show increased revenue for those other 7 or 8 years. So R&D credit has been extended, I think, a total of 18 times now for periods of 2 years. So it's a permanent credit. But for gamesmanship, they're able to show a budget that shows increasing revenues, decreasing deficits in the later years of their 10-year plans. The other thing that kicked in that people don't talk about is the phase out of our personal exemptions and the phase out of our itemized deductions. We've had a holiday from those phase outs for the last 2 years. They are back in place for January 1st, 2013. They effectively will increase high income people's tax rate by roughly another 1% up to the point these are phased out. So you're not really at 39.6. Most taxpayers in that levels will be at 40.6. Education credits were reestablished. The Mortgage Debt Relief Act that allows you to avoid cancellation of indebtedness income for settling your personal residence has been extended through the end of 2013. And there was a ton of other miscellaneous income tax provisions and business extenders. The most significant on the business extenders is R&D credit, but there were several others that we can go through, and they're available in your handout. I next would like to talk briefly just about Obamacare, and not on the medical provision sides of it, but on the tax provisions. There's 5 significant taxes that were instituted to help pay for Obamacare. The most important one, and the one I talk about most extensively, is the net investment income tax. So for high income, people with the income of over $200,000 or $250,000 if you're married, there is now a 3.8% tax on all income over those limits. There are a few exceptions to it. The most common exception to it is the exception for that to the extent it's income derived from an active trade or business. But this applies to all interest income, all dividend income, all capital gain income, all distributive income from pass-through entities, unless you meet the definition of an active trade or business. That definition is very similar to the 469 definition for the definition of a passive activity. In fact, it's the inverse. In fact, the way the provision was written, it specifically taxes if it is a passive activity. That is a huge tax. It's planned to raise over $123 billion over a 10-year period. It does change effectively. Our individual rates for marginal taxpayers was not 35 to going to 39.6. It was going to 40.6, and then it's going with another 3.8% over and above that. So you're going to have a significant number of taxpayers that are going to be effectively at a 44% effective marginal rate for their taxes. Likewise, they have increased payroll taxes to the extent you make more than $200,000 or $250,000 if you're married. The Medicare tax is currently 2.9%. That will effectively increase for the high income taxpayers to 3.8%. So basically what you'll see here is an equalization between earned income and net investment income. So what will happen is, to the extent it's not earned income and it's passive, it's going to be subject to the 3.8% tax. And in most cases, if you're active, it's going to be defined as earned income to you, and you're going to be taxed at 3.8%. So either way, you're going to have this additional surtax of 3.8%. There's some huge planning opportunities there that can avoid it. The most common method would be here is if you're in an S corporate form of business. In an S corp form of business and you're active, as long as you pay your reasonable salaries and pay your employment taxes on those reasonable salaries, the excess distributive income from your S corp will not be subject to self-employment taxes, nor will it be subject to the new net investment income tax. We think that same exception applies to pass-throughs through LLCs. It's contrary to a proposed reg. That reg was proposed in 1997. It has never become final because it's been so controversial and it's so inconsistent with, because it gives a deference to LLCs, a penalty to LLCs as compared to S corps. That's never been put in place. We're not required to follow proposed regs, but it was an interpretive reg, so it does reflect the IRS's position. But we haven't seen them enforce it aggressively, but we're uncertain what's going to happen going forward now that we have a net investment income tax, and it clearly makes a difference between the two. I think everybody's heard about the 2.3% medical device tax for devices produced in the United States at the sale in the United States. It wouldn't apply to a medical device that was purchased in Europe and brought to the United States, but it applies if you buy it from a United States manufacturer in the United States. I think we all know that that's just a pass-through. It will be reflected into the cost of capital. I don't think it will be absorbed by the medical providers overall. And that's about a $2 billion tax per year for the next 10 years. We've also drastically increased the limits on medical expense deductions. And in particularly, by increasing the limits, that is something that actually applies to lower income and middle income taxpayers, as well as the medical device tax, obviously. And then finally, your flexible spending limits. Historically, there's been no limit on flexible spending accounts. Most corporations self-imposed a limitation of $5,000. A lot of people think that was a provision that limited $5,000, but that was just the industry sort of established. But now we do have a provision that limits it to $2,500. And I personally think that medical savings accounts and flexible spending accounts were one of the greatest inventions we had, because one of our biggest problems in the medical industry is that the buyer of the service is not the payer of that. And in this case, you can put it in a situation where the buyer of the service was paying it and would be reasonable in their selection and purchase of services. These are all taxes. They total over $250 billion that have come into play. And I was shocked by the lack of debate that was discussed on this, at least pointing out that we're not going back to pre-Bush tax cuts. We're going back to pre-Bush tax cuts plus a whole set of other taxes and regimes of taxation.